Hi, this is Matthew Cratter from Trader University, and today I want to talk about a secret market that most people don't know about, but that's absolutely killing us now, that's having a huge impact on the financial markets. If you want to learn about how the economy actually works and how to make money in any environment, a bull market or a bear market, be sure to hit that subscribe button. So the metaphor I'm using here is the one of dark matter. There's thought in the universe to be something like 85% of all matter is dark matter. We can't see it, but we can feel its gravitational effects. And so it's a little bit like the tail wagging the dog. So I'm going to talk about the equivalent in the financial markets. But I'm going to begin with an old global macro trade. And this trade is basically, if you think the stock market's going to crash, if you think you're going to enter a financial crisis, you buy treasuries. This has been the playbook for hedge fund managers for many, many years. This is a trade that I've done a few times. So I'm going to show you how it works and why it broke this time, because I think it gives us a lot of insight that we're in a completely new paradigm here, a completely new regime. So this is a chart of the Treasury bond futures, the 30-year bond futures, also known as the long bond. And we can see the dates on this calendar, on this chart, are 2000. So stock market peaked somewhere in September of 2000. NASDAQ peaked earlier. Then we had this bear market from 2000 to 2002. And you can see that the long bond performed very, very well. It went from around 94 in price to almost 116, 115 something. And what this meant is that the price of the bonds went up a lot. And so if you were long the bonds, you made a lot of money. It was a very good hedge against the equity markets, the stock markets falling. And what this means is that the bond prices went up, yields went down. Yields often go down in a recession because the Fed cuts rates to make money a little bit easier. So that was the 2000 to 2002 bear market. Being long treasuries was a great trade there. You could be long the 10-year treasury, the 30-year treasury, or some form of the futures. Now, the next financial crisis was really kicked off when Lehman filed for bankruptcy. It was a result of the housing market popping and all these mortgage-backed securities blowing up. But we can see that Lehman filed for Chapter 11 protection September 15, 2008. That's when the real crash started, though it already started a little bit earlier in the year with Bear Stearns having to be taken over. But we can see here, this is when Lehman filed for bankruptcy. This is a chart of an ETF version of the Treasury, the 20-year Treasury bond. And you can see we went from about 92, even higher than previously in the 2000 and 2002 equity bear market. And so being long bonds, being long treasuries, again, was a really, really good trade. And then treasuries began to sell off as the crisis abated and we entered a new bull market. So 2000, 2002 bear market, you want to be long treasuries. 2007 to 2009 bear market, great financial crisis, you want to be long treasuries. This is what happened in this year when COVID came on the scene and we entered a new financial crisis, a new bear market. This is again a chart of the TLT. This is the 20-year Treasury ETF. It's got a duration roughly equal to those futures that we saw. Now, treasuries behaved well for the first couple months of 2020. They went up quite sharply. And then something really weird happened that we haven't seen happen before. They began to crash. They crashed from close to 180 in price on this ETF all the way down to 140, which is just an enormous move for what's considered the safest market in the world, the deepest market, the most liquid market. Now, this caused a lot of problems. For the first reason is because people are taught when you have a portfolio, you want to have a diversified portfolio. And so what you'll typically do is you'll have something like, depending on your age, of course, but maybe something 60% in stocks, 40% in bonds. And the idea of this is that when stocks go down, your bonds will go up and it'll sort of cushion your portfolio. But what happened in mid-March of this year, of 2020, is that this broke down. And it caused gigantic problems because there's no longer portfolio diversification. Bonds sold off along with stocks. Both of them went down, which is very rare. Stocks going down and bonds going down. So this made everyone's losses much larger. And when you see the Treasury market crashing, this is a very scary thing. Like I said, this is the debt market for the world's reserve currency. Now, what happens when Treasury prices go down? Well, it's like a financial tightening. We can see this is the inverse of it. This is the yields on those Treasury bonds. This is the 30-year Treasury bond, which is the longest duration bond that we have. And we can see that yields went from about, call it 85 basis points or 0.85%, and they backed up almost to 2%, call it 1.95%. Now, what does this mean when interest rates rise? Well, this means that you're putting the brakes on the economy. It makes everyone's debt more expensive. It makes it impossible to refi your mortgage because mortgages are keyed off of the Treasury market. They are always offered at some spread to Treasury market. So what this was is in the middle of the biggest crash, we had a financial tightening. It was almost as if the Fed was raising rates. They were lowering rates at the front end of the curve, the Fed funds rate and the effective Fed funds rate. But the other end of the curve, which so much is priced off of, was actually having a gigantic tightening. Now, this was happening because people were dumping treasuries. And when you dump treasuries, yields spike. Now, the Federal Reserve was paying attention to this. We can see in the FOMC minutes that they talk about what happened, several days of deteriorating conditions, a decline in market liquidity, which, as I said, is very scary because this is the most liquid market in the world, and off-the-run treasuries, which means the ones that haven't been most recently auctioned off, basically ceased to function. You had a complete freeze up in the most liquid bond market in the world. Buffett, in his Berkshire presentation from last weekend, talked about it as well in his folksy way. We got to the point where the U.S. Treasury market, the deepest of all markets, got somewhat disorganized, which I would say is sort of peddling it down. When that happens, believe me, every bank and CFO in the country knows, and they react with fear. And fear is the most contagious disease you can imagine. So what happens? What happened in March? And we can look at the dates here. It was roughly March 9th through March 18th. Huge sell-off in treasuries, huge spike up in yields. What was happening was a liquidity crisis. And what happens during a liquidity crisis is everyone tries to sell everything they can in order to get cash, especially to get US dollars. So if you're a retail investor, you panic, you sell your stocks. You're a US investor, you get it all settled in US dollars. If you are, maybe you own gold, you dump that. You sell your bonds, you sell your treasuries, you sell commodities. And then if you're a foreign investor who doesn't have dollars, maybe even you sell your local currency. You sell your Australian dollars, you sell your euros or yen in an effort to raise more US dollars. And as we said, this is one thing that happens during a liquidity crisis is stocks and bonds crash together. And this is extremely, extremely unusual. We can see this happening in the DXY, which is the US dollar currency index. This is the US dollar against a basket of currencies. And we can see that as treasuries were selling off from March 9th to, call it March 19th, we had a huge spike up in the dollar. So the US dollar strengthened against all these other currencies as a basket. And this is what happens when people are trying, in a liquidity crisis, when everyone is bidding for dollars. The price of dollars goes up because you have more buyers than sellers. Now, this is also what happened in the stock market. This is the S&P 500, and we can see from March 9th, call it right here, to March 19th or March 20th. That's when we had really the biggest drop and the real panic bottom in the stock market. People were selling. U.S. investors were dumping stocks to raise cash. Foreign investors were dumping U.S. stocks to raise cash, particularly U.S. dollars. And they were doing the same in the currency markets. So this is the U.S. dollar versus the Japanese yen. We can see those exact same dates. The U.S. dollar strengthened massively against the yen. We got just getting huge volatility in these currency markets. You can see this is what volatility normally looks like. These currency markets don't move a lot, but we got this giant whipsaw as we had a liquidity crisis and people were flooding into the dollar. Something similar happened with the dollar and the euro. We had a huge sell-off in the euro as European investors sold the euro and tried to buy dollars. Same thing happened with the Australian dollar. Australian dollar weakens, same time period, and the US dollar gets stronger against the Australian dollar. Something very similar happened with gold, which really puzzled me at the time. We can see that same period of time, the gold sold off from about 1680 all the way down to 1460. Again, an enormous move in gold, which has since been retraced. And Bitcoin followed a very similar pattern for similar dates. We got a real crash in Bitcoin. Bitcoin doesn't have any circuit breakers or any external authority, so the correction happened much, much faster there than anywhere else. But the basic pattern was sell everything, sell stocks, sell bonds, sell commodities, sell oil, try to raise US dollars. Now, why was there this huge need for US dollars? We're going to go into that a little bit, and this is the financial dark matter that I was talking about in the title. There is a market called the Eurodollar Market, and this is basically US dollars that are held abroad outside of the US, outside of the US banking system, outside of the Federal Reserve's regulations. These are US dollar deposits, US dollar loans, etc. There's this whole shadowy international system. Now, this makes sense because the US dollar is the world reserve currency, which means that it's used all over the world. And as a result, we have all these dollars that are floating around outside of the US. And this makes sense simply because everyone wants to do business in dollars. Everyone wants to hold dollars rather than holding some obscure developing world currency. You're always going to want dollars. If you're a big multinational company, pay me in dollars. Don't pay me in some obscure currency that doesn't have liquidity, that might get really quickly debased, etc. So this is the Eurodollar market. US dollar denominated deposits held overseas at banks, US dollar loans outside the system. Again, this is not the Eurodollar FX exchange rate. The euro is obviously the currency used in the EU, in the European Union, and there's an exchange rate between the euro and the US dollar. That's not what we're talking about here. A Eurodollar market is completely different. This is just a foreign exchange market. Now, how did the Eurodollar market that we're talking about, how did it get started? Well, it really got started during the Cold War when the US government gave a lot of money to Europe to rebuild everything that had been bombed out in Germany and France, etc., the Marshall Plan. And so there were all these dollars being exported to Europe. There were dollars being exported as well as the U.S. Really, the U.S. emerged from World War II as the strongest country, and U.S. citizens had a lot of purchasing power. They began to really spend and buy stuff from overseas, which sent U.S. dollars overseas. So that was sort of the beginning. This was after Bretton Woods, when it was basically decided that the U.S. dollar would be the world reserve currency, backed by gold at that point. And then the Cold War really kicked into high gear. And so countries like the Soviet Union and communist China began to worry. So they were getting paid in dollars. If they did international trade or something like that, they'd get paid in dollars, and they were holding that money in U.S. banks. And then at one point they woke up and realized, wow, the U.S. is a hostile country to us. What if they just confiscate our U.S. dollars? And so what they did, communist China, Soviet Union, there's some debate about who did it first. They took their money out of U.S. banks, they took their U.S. dollars, and they put them in banks overseas. So the first one looks like was Moscow Narodny Bank. It's a Soviet-owned bank that had a British charter. It was in the UK. And so the Soviet Union took its money out of the U.S. banking system, took its U.S. dollars, put it in this British bank. And this was really the beginning. This really took off after that as people began to hold dollars outside of the U.S. Again, these are Eurodollars. They're U.S. dollars held outside of the U.S. Now, how does this work? Well, the U.S. dollar, because it's the world's reserve currency, is basically the currency of choice for many, many different kinds of transactions. If you're buying commodities overseas, if you're buying corn, If you're buying oil, you've probably heard of petrodollars. You need to buy your oil using US dollars. Now this puts the US at a huge advantage because we can just print new dollars to buy up all the oil we want, whereas other countries actually have to do some hard work, earn some money, exchange it for dollars to buy oil. So this is one of the great advantages there is to having a world reserve currency. You can almost print oil. But and the current system is trying to move away from this. China would like oil to be denominated in yuan. There was some talk about, I believe it was Saddam Hussein who said that in 2000, I believe it was, he said that he wanted to start selling all of his oil in euros. Now the US was obviously not happy about this. We all know what happened to Saddam Hussein, and I would suggest this is one of the strong reasons. The US wants oil trade and everything else to be done in US dollars and thus maintain this power. And so there's been some moves to move petrodollar, to move the purchasing and trade of oil into a different currency, but still predominantly done in US dollars. So these would be Eurodollars. If Saudi Arabia is selling oil to China, for example, they're probably getting paid mostly in US dollars, at least for now. And so you have these dollars circulating outside the system. Also, other kinds of trade, buying goods and services. If a French company buys goods from China, they will usually pay in US dollars. China would like to get their hands on more dollars, and they much rather have that than the euro at this point. And so you have trade where that French company, in order to buy goods from China, they need to get their hands on some US dollars to give to China in exchange for goods or services. Likewise, at the loan level, at the debt level, you have a lot of loans that are done in US dollars, that are denominated in US dollars. So for example, a German company loans some money to a Japanese company, and they decide to denominate the debt in US dollars. So at that point, the Japanese company, they're going to need to pay their monthly loan payments and service the debt using US dollars. So that Japanese company is going to need to get their hands on some US dollars. They'll need to sell yen and buy dollars, or they'll need to do some trade with the US, export some goods and services to the US, get paid in dollars, and use that to service their dollar-denominated debt. So the Eurodollar system is just all these US dollar deposits and US dollar loans that are held outside of the US banking system, outside US banking regulations. And this is one of the things it means to have a world reserve currency. Now, how much debt is held outside of the US and denominated in US dollars? A bunch of estimates online. I think the BIS has it at about 12 trillion. I've seen much higher estimates, closer to 20 trillion. But these are large numbers, especially, so let's say call it 15 something trillion in US dollar denominated debt outside the US. This is significant because the US dollar money supply, the M2 money stock, is at about 18 trillion. And so that's equivalent really to all this US dollar denominated debt held in the Eurodollar market. Another point of comparison that sort of makes this 15 trillion or 12 trillion a realistic number. All the US debt right now is 25 trillion. US GDP is 21 trillion. So we're talking very large amounts of money. By some estimates, this amount of Eurodollar, US dollar denominated debt is pretty close to US GDP, which is just extraordinary. So you have this weird imbalance of dark matter and visible matter, where the US is a country, it's a certain size, it has a certain size economy, and then you have all these financial structures levered off of it. And in this case, this financial structure of the Eurodollar debt is much larger than, or it's comparable to the US. Maybe it's 50% of GDP or 100% of GDP, but it's in the same ballpark as US GDP. So, as we said, debtors who own this Eurodollar or who owe this Eurodollar denominated debt, they need to pay interest and principal on this debt. And there are a few ways for them to get their hands on dollars. They can't print dollars. The Federal Reserve can just print new dollars, as it's been doing. But if you're a foreign investor, if you're outside the US, you can't print your own dollars. You need to get your hands on them somehow. So the most common way to get your hands on dollars in order to pay off your debt or service your debt is through trade. You sell something to the U.S., you sell some units of something, and then you get paid in U.S. dollars, and then you can use those U.S. dollars to service your debt. This would be true for a country, it'd be true for a private company or publicly traded company. Now, what happened after COVID? Basically, world trade ground to a halt. It slowed down just tremendously because no one was leaving their houses. People weren't buying cars. They're buying fewer goods, besides maybe toilet paper. And so, as a result, trade plummeted. At the same time, the prices of commodities fell. Oil fell, gold fell, and these commodity prices. If you sell gold or oil to the U.S., you get paid in U.S. dollars. And so if oil prices are lower, or corn prices are lower, because everyone's been dumping them in a liquidity crisis, as a trader with the U.S., doing import-export business with the U.S., you're going to be collecting fewer dollars. Now, why does the U.S. run trade deficits? Which is another way of saying that we import more stuff than we export. We don't export very much. We buy a lot of stuff from China, or at least we used to. This is one way that the global financial system works. It's a way of getting U.S. dollars into everyone else's hands. And so if you run the world reserve currency, it's very hard to do it without running a trade deficit. But as we said, under COVID, this trade is really a fraction of its former self. And so it's much more difficult for people outside the U.S. to get their hands on U.S. dollars. And especially if you have a big debt that you're servicing and you're used to constantly paying it off every month from exporting stuff to the U.S., when that slows down, all of a sudden you're unable to get your hands on dollars to service your debt. So then what do? If you can't get U.S. dollars through trade, another option is to dump U.S. assets. So right now, foreign investors, which includes individuals, companies, central banks, own about $40 trillion worth of U.S. assets. Now, this is very large, especially when you consider our GDP is just 21 trillion. And out of this 40 trillion in U.S. assets, 7 trillion are treasuries, and the rest are stocks, corporate bonds, real estate, etc. And so if you can't get your hands on dollars, you really need some U.S. dollars, and you need them now, and no one's trading with you, there's no demand for oil, for example, what you need to do is you need to sell off some of your U.S. assets to raise U.S. dollars. So I dump my treasuries, I get some U.S. dollars, and then I can service my Eurodollar debt with that. Now, what happens when you dump treasuries? This is basically what we saw happen in March of 2020. This was foreigners dumping treasuries in order to get their hands on U.S. dollars. They were short U.S. dollars, and so they needed to sell treasuries. And in the process of doing so, they spiked interest rates. If you spike interest rates too much, all of a sudden people can't get mortgages, people can't borrow money. The whole U.S. economy, we're really a consumer-based economy where people like borrowing lots of money. And if interest rates go up too much, then the economy is in a lot of trouble. So what happened instead? Well, foreigners were dumping treasuries, foreign investors, and as a result, the Fed had to take up the slack. They did not want interest rates. They did not want the 30-year interest rate to be at 2%. That's just extremely tight during an economic depression, and so the Fed had to step up and print new money and buy treasuries to prop up the treasury market. Now, this is a weird thing because it's one part of the government, the Federal Reserve, buying the debt of another part of the government. A lot of you will tell me the Fed's not part of the government. This is sort of a technicality. The Fed has a lot of power. It's part of the ruling power. So we can not worry about the semantics for now. But basically, you have the Treasury issuing debt, so Congress can spend a lot of money, and then you have another part of the government printing new money, making up new money, printing new U.S. dollars or creating new digital dollars, and using them to buy treasuries so that interest rates don't spike too much. So those are the two main ways. You can trade with the U.S. to get U.S. dollars, or you can just sell some U.S. assets that you own. You can sell your California real estate. You can dump your Apple stock, or you can dump treasuries. Treasuries are very liquid, and they're much easier to sell. And this is what we saw happening. And the Fed had to step in. They could not let interest rates spike. And so this is the tail wagging the dog. This is the financial dark matter, where the Eurodollar universe is having this impact on our central bank. And that our central bank, the Federal Reserve, is needing to defend the Treasury market from these foreign investors dumping Treasuries by printing new money, expanding the money supply, and buying the Treasuries itself. Now, this became very tiresome and very dangerous. The Fed can only, it's not good for the Fed to buy too much stuff and expand its balance sheet. So what they did is they also increased what are called currency swaps. And so how does this work? Well, another country comes to the Federal Reserve, our central bank, the U.S. central bank, brings a chunk of their currency, of their local currency. Maybe they come with some yen or some euro or Australian dollars, and they deposit that currency at the Fed. And in exchange, the Fed prints some new U.S. dollars and gives it to that country. So what this does is it gets U.S. dollars into foreign investor hands, whether central banks, and these currency swaps are done between central banks. I don't think you or I could just go to the Fed and do a currency swap with them, but maybe foreign banks and central banks. And so it's a way of preventing foreigners from dumping U.S. assets. We basically swap out their currency for some U.S. dollars. They get their hands on those U.S. dollars. They can lend it through their local banking system and allow the companies and everyone else to service their Eurodollar debt. So these currency swaps are a way of stabilizing the Treasury market. But in the process, it's another reason the Fed has to print new dollars. So these currency swaps, the Fed does them with major countries, major economies like Japan, the European Union, maybe the UK, Australia, Canada, etc. But if you're a developing country and maybe you have a currency that people don't trust quite as much, the Fed did not want you as a small country to be dumping your treasuries too. And so what it did is it just started, I believe this was new this year, something called international repo. And so if the Fed doesn't really trust your currency, if it's not one of the major 4 or 5 currencies, what you will need to do as a small country or developing market country, is that you bring your treasuries to the Fed, you deposit them there, and they basically hold it. They hold it there, and then the Fed will give you U.S. dollars. So you don't have to, instead of dumping your treasuries and selling them and driving up interest rates, the Fed will just take your treasuries, hold them on deposit, and then give you U.S. dollars. And when you're done with those U.S. dollars, you bring them back, and then you get your treasuries back. But this is kind of a weird thing too, where the Fed is printing new dollars in exchange for treasury. So all of this increases the U.S. money supply. Now, why is this important? Well, the longer COVID's effects happen, and it looks like South Korea, for example, is seeing a new spike in infections. California is. It looks to me like it's going to be fairly difficult to open the economies back up. We'll have these sort of rotating hotspots. Whoever opens up will have a resurgence in the virus, and they'll need to shut back down again, at least until we have some antivirals or a vaccine. And so the longer this shutdown goes on, the less trade there's going to be. And as a result, there's going to continue to be a huge shortage of U.S. dollars abroad, a shortage of offshore dollars in the Eurodollar market. And so the Fed is going to need to continue to print money to buy treasuries that foreigners are dumping. It's going to need to continue to print money to do currency swaps. And the Fed is going to need to continue to print money to do international repo and get dollars in the hands of foreign investors. And so what this means is that the money supply will continue to go up. This is another reason the Fed needs to keep printing. And as a result, scarce assets, we've talked about this in other videos, things like gold and Bitcoin, coastal real estate, rare paintings, Picasso's, Van Goghs, anything that has scarcity will go up as more dollars are printed. I'll link to this article. Here's the dollar swap, the currency swaps that the Fed's doing with other central banks. This is a chart of the Fed's balance sheet. And one of the main reasons it had to expand so much in March is right during this period, you can see, call it March 11th through the end of March, it went up by about $2 trillion. And this was mostly the Fed buying treasuries that foreign investors were dumping. And they had to print new money to do this and thus expand their balance sheet. Now this has become a problem simply because the U.S. is in a debtor position with regard to what's called the net international investment position, also known as NIP, NIIP. You can see that we have the biggest at negative 11 trillion. Now, what does this mean exactly? Well, we have foreign assets that are owned by the U.S., and then we have U.S. assets that are owned by foreign investors, foreign nations, foreign individuals, central banks. So right now, the U.S. owns about 29, as of the end of 2019, about $29 trillion worth of assets that are in other countries. Foreigners, outside U.S. investors, own about 40 trillion worth of U.S. assets. And so if you subtract these two numbers, basically we can see that the NIIP is negative. The foreigners own more U.S. assets than the U.S. owns foreign assets. Now this is what happens when you run a trade deficit. You're constantly pumping money overseas, and then those people you trade with, they take those dollars, they come to California and they buy buildings, they buy if they're Chinese, they come here and they buy gold mines, or they go to Canada and buy gold mines. But this U.S. liabilities right here would be assets owned by foreign investors. Now, this is the U.S. net international investment position over time. We can see that at the beginning of the previous crisis in 2007, 2008, it was close to about 1 trillion. In other words, foreigners owned $1 trillion more of U.S. assets than U.S. owned of foreign assets. It has since ballooned to 11 trillion. And what this basically means is that the U.S. is selling itself to people outside the U.S. I can say U.S. is selling itself to foreigners. I don't mean that in a negative way, but this clearly is a bit of a national security issue. Do you want to sell your country to outside countries, especially if they're possibly hostile? Russia could be hostile, China could be hostile. Do you want them to own big chunks of your country? So this is one problem with having a world reserve currency. This is one of the negative effects, is you basically end up sending all your manufacturing and jobs overseas, and then foreign investors, foreign countries end up owning big chunks of your country. We can see that as a percentage of GDP, this scale is a little bit off. It's basically because I'm dividing trillions by billions by trillions. But basically, at the beginning of the previous crisis, the 2000s, the Great Financial Crisis, 2007 to 2009, the NIP as a percentage of GDP was about minus 10%. So this is basically just normalizing for the productive capacity of the U.S. economy. Now it's closer to 50%. What we've basically done, this is equivalent to some wealthy family. Maybe they live in a big castle. It's money that's been around for 100 years. And let's say for the next 10 years, to finance all their spending, they sell off all their heirlooms. They sell all their jewelry. They cut off part of the land and sell it. This is what's happened. We've gone from a minus 10% ratio here to a minus 50% ratio. And as a result, what this means is that we're very dependent on foreign investors, especially when they own a lot of our treasuries. If they decide to dump them, we're in trouble. Interest rates spike. And so what happens is the Fed has to end up backstopping the entire system. Now, on top of this, COVID has made it really necessary for the U.S. government to spend a lot of money to try to stimulate the economy. The Congress has for many years been spending a lot more than it brings in tax revenues. It makes up the difference by issuing debt, by issuing treasuries. This quarter, they're saying the Treasury is going to need to borrow $3 trillion. We don't have this money. We can't collect it from tax receipts. So this means $3 trillion more U.S. debt, more treasuries out there that we need to either sell to foreigners, and they don't seem to want to buy them anymore. We need to sell them to to retail investors who don't know what they're doing, who are happy to get 0.5% yield, or we need to sell it to the Fed. Probably the Federal Reserve is going to need to print new money to monetize these deficits, to buy and sterilize the debt and hold it on its balance sheet. Now, on top of that, the Fed has said that they're going to buy junk bonds. This is the JNK, the junk bond ETF. And so we're really in a position where, because of our debtor status, because of the huge deficits we run, and because of the weird negative effects of having the world's reserve currency, the Fed is going to have to end up buying everything. The longer this crisis goes on and the lower trade levels stay and the longer commodity prices stay low, the more the Fed is going to have to do these dollar swaps and supply liquidity, supply US dollars to the rest of the world, so that the rest of the world doesn't dump its treasuries and other US investments. If they dump stocks, it hurts us. If they dump treasuries, it hurts us. And so the Fed is going to have to buy treasuries. It's either going to have to buy treasuries or issue these swaps, create money out of nowhere, and give it to countries to bribe them not to sell their treasuries. So what happens is, and this is why we get these calls. We just got a call on March 6th from Eric Rosengren saying the Fed needs to broaden the assets it can buy. Janet Yellen was saying that the Fed should be allowed to buy stocks. You have a really weird situation where the Fed ends up buying everything. They have to buy all the treasuries, all the U.S. national debt. They have to backstop all the total debt, the personal debt, the corporate debt, the local debt. You can't just let California go bankrupt. You can't let New York State go bankrupt. These things ultimately have a Fed put. And Alan Greenspan was very famous for saying in 2015, the U.S. could never let Bank of America or J.P. Morgan go bankrupt. So at a certain point, the Fed will need to buy them too if the banking system goes into trouble. It's going to need to buy all the federal debt. It's going to need to buy all the backstop the entire financial system. And ultimately, it's going to need to monetize all the unfunded liabilities that are coming due as the baby boomers retire. Medicare, Social Security are the big ones. And so we're talking hundreds of trillions of dollars. And when you add in the Eurodollar market, which we've spoken about, the sort of dark matter, that's another, when you look at the total size of the Eurodollar market, I've seen quotes of 50 or 60 trillion. You end up with, because of the path we've gone on being a world reserve currency and living beyond our means, the Fed is going to have to buy everything. And how does it buy everything? It buys it using printed money. It prints new money, which devalues the money in your pocket. The value of the US dollar is going to need to go down massively. Like it did in the early 30s, you're going to need to have a devaluation of the US dollar. It's going to happen all of a sudden, or it's going to happen gradually. It's hard to know if things break or if we can sort of keep it together and do a controlled devaluation. But what this means is things like gold just go up tremendously, and Bitcoin. And so this is one of the main reasons I'm very bullish on physical gold, real estate, Bitcoin, possibly even stocks. But I think really Bitcoin and gold will perform better than stocks. So that's the Eurodollar market in a nutshell, and how it really is the tail that's wagging the U.S. financial system's dog. If you found this helpful, be sure to hit that subscribe and like button. Let me know your questions and comments in the comment section below. I know we covered a lot. I hope to explore this area a lot more fully. We live in an interconnected global world. All the global financial systems are connected. And so it's very important to understand how these things work and just not to have naive faith that the Federal Reserve is going to make everything okay. They are dealing with a lot of issues, especially this external Eurodollar issue. And it's going to make it very difficult for us to get out of this decade in any decent financial shape. Thanks a lot for listening, and I'll see you in the next video.